Good afternoon and welcome. First, I should just note there are some seats in the front. Folks shouldn't be afraid to sit in the jury box if they want. My name is Jonathan Adler, and I direct the Center for Business Law and Regulation here at the Case Western Reserve University School of Law. Welcome to today's event on the mortgage crisis and the response by the Consumer Financial Protection Board. The Center for Business Law and Regulation was founded in 2003 to help enhance and augment our curricular and other programs that help train lawyers to deal with a changing and ever-challenging business environment. We sponsor research, classes, and programs that encourage debate over the role of government in the regulation of business, and public forums and lectures like today's lecture. This is the Dean Lindsey Cowen Business Law Lecture that was established in 2002 with a gift from the Ferry Family Foundation, and we're certainly appreciate their support of this program. The lectureship is a lasting tribute to Dean Cowen, who served as both a professor and dean of the law school from 1972 to 1982. Today, it's my distinct pleasure to introduce this year's lecturer, Todd Zywicki, who is the foundation professor of law at George Mason University School of Law, as well as a senior scholar at the Mercatus Center and co-editor of the Supreme Court Economic Review. At George Mason, Professor Zywicki teaches courses related to bankruptcy, business associations, and public choice in the law. He's also taught at Georgetown, Vanderbilt, and the Mississippi College of Law, among other law schools. From 2003 to 2004, he was director of the Office of Policy Planning at the Federal Trade Commission. Previously, he clerked for Judge Jerry Smith on the U.S. Court of Appeals for the Fifth Circuit, holds a law degree from University of Virginia, a master's in economics from Clemson, and his bachelor's from Dartmouth. But without any further ado, I will turn it over to Professor Zywicki. Todd,
Thanks, Jonathan, and thanks for everybody coming out today. It's a real privilege and honor for me to be here at Case Western. I'm really humbled when I look at the list of people who have, the distinguished list of people who have given this lecture before me, and it's a real treat for me just to be mentioned in the same breath as a lot of those people. So what I'm going to talk about mainly today is what I understand to have been the underlying causes of the mortgage crisis. And what I'm going to really focus on is the consumer side of the equation, the sort of foreclosures and that sort of thing, rather than the back office sort of Wall Street stuff, although that plays into it. And what I'm going to do is work through and sort of explain what I think happened, and then explain why I think that the Consumer Financial Protection Bureau idea that's been enacted into law will not only likely be ineffective at addressing the problems that we saw that caused the mortgage crisis, but could very well and quite likely might be a precipitating cause of a next financial crisis, and that on net, it will almost certainly do more harm than good for American consumers. So let's start with sort of the story that causes everything else to hang together, which was the rise in home ownership beginning in the early 90s, peaking around 2005, and then retreating back since then. What we see is historically home ownership hovered around about 64% of American families owned homes. We boosted that up over 69% before it's retreated back because of foreclosures and that sort of thing. Now, this is important in a variety of ways, which is first, this is a real cautionary tale about the hubris of social engineering, which is to say that the idea of expanding home ownership was a bipartisan experiment. Everybody was on board on it. It seemed everybody I talked to, everybody studied, seemed like it was a good idea. I was persuaded myself. And the logic was basically that what we see is that home ownership is really correlated with the good things in life. Better results for kids, lower crime, nicer neighborhoods, better schools, more people vote. All kind of things go along with higher rates of home ownership. What we thought was that it was causal, that becoming a homeowner would make you a more responsible person. What we subsequently discovered is that it was purely a correlation, which is to say that responsible people wanted to own homes. And a responsible person was basically a person who was the kind of person who was willing to save up for a down payment, who wanted to have good schools, who wanted to vote, who wanted to take care of their property and that sort of thing. And what we basically did during this period was to create sort of a new artificial class of homeowners, people who are buying homes for very different reasons. And what we're going to see is that the type of people who became homeowners and the reasons that they became homeowners were very different from those who came before them. And in many ways, that's the key to understanding both the boom and the bust in the housing cycle. And we'll come back to that later. This is just sort of annual data. I didn't update 2010. This is just foreclosures started, just to give you a sense of sort of what we've seen. And this is annual, just lumped together, just to give you a sense of the trend. Now, there's one thing I want to point out here, and I'll refer to it later, but historically, what we see is that there was a gradual upward trend in foreclosures, but not that much. But what you really want to notice on this chart is that historically, what drove a variation around the trend line, caused foreclosures to be unusually high, were macroeconomic conditions. So that the best predictor of whether foreclosures are going to be higher than usual was the general economy, the unemployment rate, and that sort of thing. And so what we would see is during periods of recessions, you'd get a little bump in the foreclosure rate, and then it would drop back. Obviously, that's not what happened over the past couple of years. Over the past couple of years, the housing crisis and foreclosures led to macroeconomic problems rather than macroeconomic problems leading to that. Having said that, what I'm going to do is divide the mortgage crisis and the foreclosure crisis into three phases. We are now in what looks like the third phase to me, which is very consistent with this historical model, which is a model predicated on high unemployment, macroeconomic problems, and that sort of thing. So I don't want to dismiss it because it's important to what's going on. I just want to, that's not the real interesting story here. Okay, what are these three phases? Well, phase one, I'm going to argue, was related to payment shocks and especially adjustable rate mortgages. Phase two is going to be caused by negative equity and what I'm going to call the put option, and then phase three is going to be this macroeconomic problems issue. Now, is a very oversimplified way of thinking about this and keeping it straight in our head. What I want to try to distinguish just as a shorthand is between those who want to keep their homes but can't afford to, from those who could keep their homes but choose not to. And the first are basically people who are forced into disclosure by an inability to pay their mortgage and financial distress. The second category are people who could afford to pay their mortgages and keep their homes but choose not to, basically because it's a bad investment. What I think we're going to see is that we've got different things going on as we move through the housing boom and bust. But understanding actually accurately understanding the underlying causes of the foreclosure crisis is necessary to understand what comes next. And in particular, if, as we'll see, a lot of what we see is people responding to incentives. If we intervene based on the idea that people don't respond to incentives, we could be creating a set of bad incentives that could create moral hazard problems and the like, and I'll explain that in more detail. All right, so what's the first phase? This is what I call the payment shock in arms or distress model. Now, this is a chart going back to the early 80s on mortgage interest rates. The blue line is the average interest rate on a 30-year fixed-rate mortgage. The pink line is the average interest rate on adjustable rate mortgages. Now, note a couple things about this chart. Number one, during that period, there is a clear general downward trend in interest rates generally, beginning in the early 80s up until around 2000 and today. Why that is, we're not exactly sure. Partly it may be, if you've heard about Federal Reserve Chairman Ben Bernanke talking about the global savings glut or capital glut, that might be part of it, that there was an inflow of a supply of lending capital into the United States from the rest of the world. Could be part of it. Part of it was just better monetary policy, right, and low inflation. But the overall effect is that there was a real downward trend in interest rates. What that means is that there was also a real upward trend in housing prices, which is that if interest rates go down, you can pay more for a house because your monthly payments will be lower. And so what we're going to see is that over this period, a good portion of the rise in housing prices was fully sustainable in light of this downward trend in interest rates. Note the second aspect of this chart, which is that at all times the blue line is above the pink line. What does that mean? Basically, what a fixed rate mortgage is a situation where you have to pay the bank to bear the risk of interest rate fluctuations. So that's what a fixed rate mortgage is. If you got variable rate, then you bear the risk of interest rate changes. If it's fixed rate, then the bank bears the risk of interest rate fluctuations, including your ability to refinance if interest rates go down. On average, you pay the bank about 100 to 150 basis points, 1 percentage point to 1.5 percentage points, to bear that risk. That's a pretty big premium. 100 to 150 basis points that you pay the bank in order to bear that risk. You also pay the bank a premium in order to be able to refinance your mortgage when interest rates go down. And in fact, the mortgage that we have in the United States, the 30-year fixed-rate self-amortizing mortgage with an unlimited right to prepay, we are the only country in the world that has that mortgage. It came in as sort of a Band-Aid that was created during the Great Depression, and we've kind of been saddled with it ever since. Most of the rest of the world, consumers are not willing to pay 150 to 200 basis points for insurance on a fixed rate mortgage. And this is something we're going to come back to later. One of the things to think about then is that one of the things we're going to see in Dodd-Frank and the Consumer Financial Protection Bureau is this belief, this sort of affectation about the value of the traditional 30-year fixed rate self-amortizing mortgage. And what we have to ask ourselves is, that may be valuable if you plan on being in your house for 30 years. To buy 30 years of interest rate insurance may be valuable to you. But truly, if you are going to be in your house 5 or 7 years or something like that, that's an awfully large insurance policy to buy 30 years of interest rate insurance for if you're only planning on being in your house in a shorter amount of time, in addition to other sorts of problems that we'll talk about. Note the final thing about this chart, that over time, generally what happens is, or the third thing is that over time, adjustable rate mortgages are leading down fixed rate mortgages. The real confusion here is from 2001 to 2007. What we see from 2001 to 2007 is from 01 to 04, the Federal Reserve takes down interest rates, short-term interest rates to a very low level. And from 2004 to 2007 or so, it brings them back up very rapidly. Note that the 30-year fixed-rate mortgage hardly budges during that period. What we get is a dramatic and artificial drop in short-term interest rates, but not long-term interest rates. That becomes the crucial part of this story, as we'll see. So that's sort of setting up the payment shock problem. Okay, and this is the chart just to show, as I was saying, that housing remained relatively affordable because of the downward trend in interest rates. And this is just sort of a rough and ready estimate. An affordability index of over 100 means that the median priced family can buy the median priced house in their community. This is just a snapshot of the entire country. What we see is, so for instance, in the early 80s when interest rates were very high, homes were very unaffordable, but for most of this period, homes generally were affordable for people even though prices were going up. All right, so now it's where it starts to get interesting, which is what we saw back on this chart here was that on average, interest rates between short and long-term interest rates are about 100 to 150 basis point spread, but not always. As you can see, sometimes it's broader, sometimes it's narrower. Now look at this chart. This is a chart on the market share of fixed versus adjustable rate mortgages over time. Now again, we have this belief that everybody has always had a 30-year fixed rate mortgage. That doesn't seem to be true, and it hasn't been true for a very long time. If you look at this chart, which is far back as I've been able to find, to the mid-'80s, well, we see that there were periods in the 80s and 90s where as much as 40 or 50 or 60% of the mortgages that were being written, either as purchase money or refinances, were adjustable rate mortgages. We see that the blue are the percent arms. So we see that in the late 80s, we see that in the mid-90s, and we see our local bulge around 2004, when about, according to this data set, about 40% of the mortgages that were being written were adjustable rate mortgages. So ARMs go back before subprime lending was even a gleam in Angelo Mozillo's eyes, right? We've had adjustable rate mortgages around for a long time. Now here's where it gets interesting. What drives this pattern? Well, if you take the two charts I showed, and you take the spread between fixed and adjustable rate interest rates, and that's the blue dots here, and you take the percentage of ARMs in fixed rate mortgages at any given time in the market, what do you notice? You notice that as the spread gets wider, as adjustable rate mortgages become relatively less expensive relative to fixed rate mortgages, what happens? People flip over from fixed to adjustable rate mortgages. So if you look at the chart, what you see is as the spread, for instance, approached 3% in the late 80s, the percentage of adjustable rate mortgages hit 60%. And it's undeniable correlation here, right? Sometimes there's a lag, but the pattern is obvious. Eventually, as adjustable rate mortgages become relatively less expensive, as it breaks out of that band of 120 or so basis points, people flip over. And that's what we saw in 2004 because of the Federal Reserve creating that bulge between short and long-term interest rates. People flipped over to adjustable rate mortgages and the like. And that then is what creates the onset of the mortgage crisis, which is if you look at subprime mortgages, what you see is that the subprime mortgage crisis was actually a subprime adjustable rate mortgage crisis, which is that what we see is as the Federal Reserve basically took interest rates down very low, and people took out adjustable rate mortgages and then whipsawed homeowners by taking interest rates back up, what we saw was that subprime adjustable rate mortgages were the first the domino to fall. Note that fixed rate subprime mortgages did not explode. And until very recently, fixed rate subprime mortgages were below their all-time high in terms of foreclosure rates. Now, to some extent, yes, there's a selection bias here. Among crummy borrowers who get subprime mortgages, fixed rate subprime mortgage borrowers are somewhat less crummy than ARM borrowers. But I don't think that explains the whole story. And in particular, what if you looked at prime mortgages? You would see exactly the same thing, which is that you see foreclosures on prime adjustable rate mortgages start to rise at exactly the same time you see foreclosures on subprime adjustable rate mortgages rising, and subprime fixed rate mortgages do not start rising until later on. Should I take questions as I go or just hold till the end? Okay. And what we're going to see is the last bit over on the end is what we're going to see when we get to phase 3 is that now the fastest rising group of foreclosures is prime fixed rate mortgages, which we'll fit in the third thing. Why is there some data missing? Basically because I need to buy the rest of the data. I bought the data where it's constant, and then I've just gotten the rest of the data from public sources. So that's the only reason why there's a gap in here, is to just kind of give you a sense of what's happened since then. But the data's kind of expensive, so I don't buy it until I only buy it periodically if I can to figure out what's going on. So the way I see it is what happened was the initial onset then was an ARM problem. It was economic distress caused by the Federal Reserve's erratic monetary policy. And that's really what it was, is there's nothing intrinsically dangerous about ARMs. What is dangerous about ARMs is when you get crazy monetary policy like the Federal Reserve had from 2001 to 2007. There's other periods where we had ARMs. The reason why foreclosures didn't skyrocket, as I mentioned, is because usually the spread was being caused by ARMs going down before fixed rate mortgages went down. That didn't happen this time. Interest rates went artificially low and then came right back up. The other thing that's related to that is Alan Greenspan has said, you can't blame me for the financial crisis because look at the 30-year fixed rate mortgage. It hardly budged. And I say, I'm sorry, Mr. Chairman, I can blame you because you weren't focusing on the right thing. Yes, he was focusing on the 30-year fixed rate mortgage, but what he didn't realize is that he had changed people's behavior. He changed people's behaviors such that they were taking out ARMs and the fixed rate mortgage didn't matter quite as much anymore. People were sort of selecting for that, right? And so I think that I can blame him, and I do blame him. And in his defense, right, what he was doing in 2000, for 2001 to 2004, was he was responding to the double crisis of the dot-com bubble bursting and the loss of wealth from that, and the 9/11 attacks, and a concern that the United States was going to fall into a deflationary spiral like in Japan. And he's actually subsequently said exactly what I predicted he would say, which is he said, my concern was that by taking down interest rates, we would cause a general rise in the price level, right, inflation. I don't think he or anybody else saw what actually happened, or maybe some farseers did, but most conventional economists didn't see what was going to happen, which would be the creation of a bubble in one particular asset, as opposed to just having to deal with inflation after the fact. So I give him, I don't want to blame him too much, but he did change people's behavior. So that was the first onset. Then the second phase, I think, is what we could call the option model, the put option. And the idea here is basically you can think of your mortgage as an option. Every month you can pay your mortgage, and if you do that for 30 years, at the end you buy your house, right? So you have the option of paying your mortgage every month and retaining the right to buy your house. Or you have the option of not paying your mortgage and giving the house back to the bank in a foreclosure process, right? Now, what would we expect to affect, and there's a lot of economic literature that describes this as basically being the model that motivates a lot of foreclosures. What would you expect then to be the variables that affect your willingness to exercise that put option? Well, if the value of exercising the option goes up, an economist would expect that people would exercise it, or if the cost of exercising the option goes down, you would expect that people would exercise it more often. And in fact, what this chart shows is that as the value of exercising the option of giving the house back to the bank goes up, people started to exercise the option more frequently. So when housing prices fall, it becomes a lot less valuable to you to continue making the payments and buy the asset at the end if the asset is not going to be worth what you paid for it, right? And so what we see is that housing prices began to fall, foreclosures started to rise. And that's sort of the dynamic that's driving a lot of this. And we all understand this, that when houses are underwater with no prospect of coming back above water, that's when foreclosures tend to occur. Another factor would be that if the cost of exercising the option goes down, you would expect people to exercise the option more frequently. So a good test of this is several states have what are called anti-deficiency or non-recourse laws, California and Arizona being two of them. What you see in those states is that if you fail to pay your mortgage, the bank is basically limited to taking your house back. So if you owe, say, $400,000 on your mortgage and your house is only worth $300,000, in most states, you could give the house to the bank, but the bank could still sue you for $100,000 that you owe on the note. In some states, you can't do that. All they can do is take back the house. It's like a get-out-of-jail-free card, right? Now, the estimates are that when housing prices fall, in a state with an anti-deficiency law, foreclosures are 2 to 3 times higher in states that have anti-deficiency laws than states without, which is exactly what an economist would predict. Secondly, even more robust is what we see is that incentive effect is greatest for high-income, high-wealth borrowers with big houses. Why is that? Because they are precisely the sort of people who would otherwise have money in their bank account and other assets that could be seized with respect to judgment. Lower income people don't have that. So the get out of jail free card is much more valuable to a high income, high wealth person. And so as a result, that incentive effect of anti-deficiency laws is greatest for those sorts of people. And so one of the things we see, for instance, is in England, which has had a similar boom and bust cycle with respect to housing prices. England has not had nearly the same level of foreclosures as we've had in the United States, at least the last time I checked the data. And one reason is because they have very tough laws when it comes to foreclosing on people's houses and that sort of thing. That also helps us to understand then where the underwriting and where the loan process went so bad. Which is, if you look at the data, what it strongly suggests is that of all the crazy, stupid, idiotic things that the banks started doing, the craziest, stupid, most idiotic was the development of products that caused people not to have equity in their homes. No down payment mortgages, piggyback seconds, interest only, cash out refinances, and the like. Why is that? Because if people either don't have equity in their home or they suck the equity out of their home by a cash out refinance, if their house goes down in value, they fall into negative equity territory much sooner, and that option comes into the money much sooner. Again, contrast that with Europe, such as in England, where you generally cannot refinance your mortgage. And so as a result, when your house goes up, you have to leave your money in your house. And so as a result, if prices fall down again, then your option doesn't come into the money quite as quickly. That's the thing that drives everything else. And in fact, what the data tends to suggest is that the borrower quality did not deteriorate between 2001 to 2007, which is to say that FICO scores for borrowers seem to have been pretty much the same. It's hard to get a handle on it, but at least for subprime, borrower quality FICO scores seem to be about the same from 2001 to 2007 during that whole period. What did change, though, was everything else about the loan. So what it looks like is that they were not making more loans to crummier borrowers. They were making crummier loans to the same borrowers. Right? And of course, as we'll talk about later, this not having to put equity, not having to put skin in the game, also is one of the things that fueled the speculative fervor in a variety of cities. And that's what unlocks it, right? And so the idea here is that these were incredibly stupid loans, and we might want to have regulations that say that banks can't make these loans because they're so stupid. But the reason why we don't want to allow banks to make these loans is not because people didn't understand what they were doing. It's because people understand now all too well what they were doing, right? Which is to say, if a bank comes to you and says, here's a couple $100,000, pay it back if you feel like it, right? That's a pretty good deal, especially if you're in there's obviously other things related to that, but the problem is not that people didn't understand what was going on generally, which is the structure of incentives that the banks were setting up. The banks were setting up a structure of incentives where it became very strong incentives for people to walk away from their homes. And this is just a quote from The Big Short, a book I really recommend, which I think kind of captures it, where the guy says, the borrowers will always be willing to take a great deal for themselves. It's up to the lenders to show restraint. When they lose it, watch out, right? And so a lot of what was going on here turned out to be, for a lot of borrowers, not all borrowers, obviously, a pretty good deal. And that's what drove sort of the second aspect. It also, I think, explains quite easily why efforts at foreclosure remediation and renegotiating people's mortgages have been such an abysmal failure in most of the country, which is to say that they've been proceeding on the assumption that what we have are people in the first category, which is people who want to keep their houses but can't afford to. And so all we have to do is reduce their payments or stretch out their payments or whatever. But what they haven't done is address the incentive effect, which is whether or not people decide that it's worth it to keep the asset and the ability to purchase the asset. The third phase then, as I mentioned, and I'll just mention again, is I think we're into a third phase now where we are seeing macroeconomic problems. And as I mentioned, the fastest rising group of foreclosures the last couple quarters has been prime fixed rate mortgages, which I think is a combination of people losing their jobs, getting income reductions, and then it becomes much more tempting if your house is underwater, and it's going to be a lot more of a sacrifice. Those are probably the people who are sort of least elastic, or most inelastic to responding to that. So if you want to know sort of the bottom line of where I think the underwriting went wrong, lenders fundamentally both underestimated both the decline in home prices and the propensity of this new group of homeowners to walk away when prices fell. And what we've seen is that bulge that I showed on the first slide, that bulge of new homeowners, have been much more responsive to the incentives of the put option than previous borrowers and homeowners. And what we saw was a group of people who were basically buying for either a speculative or quasi-speculative investment, and they're exactly the ones you would expect to respond to incentives. All right, let's talk about the final part of this part of the presentation, which is the last aspect of it to understand what was going on. And we've come to think of the foreclosure crisis as a national crisis, when in reality it looks like it probably isn't. It is a national problem, that is no doubt, but it's not a national crisis, I'm going to argue. The banking crisis was a national crisis, But the foreclosure crisis has not been a national crisis. And what we see, it looks like, it turns out we've got three different kind of real estate markets in the country. The first is what I could think of as traditionally volatile markets, such as DC, New York, Boston, and San Francisco. These are markets in which prices go up and down a lot over time. What causes prices to fluctuate so much over time in these places? Well, primarily that they have very inelastic supply of housing, which is to say if there's a demand shock, like those very low interest rates I showed, what happens is that prices bounce around. So if interest rates go down, prices go up. If interest rates go up, prices go down. There's also a lot often, why is that? The reason is primarily because of very strict land use controls that limit the ability to build new housing. Also geographic limits, obviously, in coastal cities and that sort of thing. The second group that we saw is what we could call steady growth cities, Dallas, Charlotte, Houston, Indianapolis. These are cities where if there's a demand shock, you just build more houses. And they're generally flat places where it's with loose zone, land use rules. And so we saw in these cities where the demand shock caused them to just build more houses. Prices gradually went up, prices gradually went down. Now, in these first two categories, volatile and steady growth, there's not been a foreclosure crisis. Where there's been a foreclosure crisis is what really does truly seem to be bubble cities. Phoenix, Las Vegas, Miami, Tampa, Orlando, and the Inland Empire of California. These are areas that seem to have had the price patterns of the first city and the land use patterns of the second city, which is that they built a lot of new housing and prices went up a lot. And prices have fallen back down, and everybody in these cities know that prices are never going up again. In the first group of cities, I live inside the Beltway in DC, we know that eventually prices are going to go back up again because there's a limited supply of housing. In these cities, prices are never going to fully recover. And in fact, these are the cities in which this is the areas in which we see the foreclosure crisis. And just to give you sort of an intuitive sense of it, at the height of the foreclosure crisis, 42 of 50 states had below the national average of foreclosures, the mean. Right? What does this tell you? It tells you that there's a handful of states that are way up here and everybody else bunched down here. When 42 of 50 states are below the average. Well, about 1% at that time of mortgages were in foreclosure. It was 2.5 or 3 times higher in these various cities: Florida, California, Nevada, and Arizona. And the other thing we see in these cities is that these are the cities in which there is an unusually high level of speculative activity. Now, you go and you talk to the people in Arizona and Florida and places like this, and what they tell you is that they thought that they could actually build more houses and sell them for more. And their logic was, and it's kind of an interesting insight into bubble mentalities, their logic was that it was all these wealthy baby boomers who are buying their retirement homes. And so there was going to be this constant influx of new people wanting housing. And so what they thought was that the collapse was going to come in New Jersey and Ohio and Illinois, right? Well, now that everybody's savings have been wiped out, those second homes in Florida and Arizona are now the ones that basically people are giving back to the bank. But what we see here is the unusually large rise in the percentage of investment in second homes in these cities that were basically speculative investments, and these are the ones that you would most expect to end up in a foreclosure. So now let me spend my last remaining time of my remarks then to think about what does this all mean for a federal response. The federal response was chosen was the creation of a new Consumer Financial Protection Bureau. And I think that misses the point, number one. And I think, number two, that a number of the things that are in the Consumer Financial Protection Bureau are going to actually exacerbate the problem rather than ameliorate it. And the problem is that the premise of the Consumer Financial Protection Bureau, I believe, is premised on an incorrect assumption, which is that the primary reason why we ended up with a foreclosure crisis was because of consumer protection problems. Rampant fraud, and everything else that goes along with that. When in reality, what the data tells me, in the argument I've made today, is that the problem was misaligned incentives. And as I said, we might want to prohibit banks from making nothing down loans. But we might want to prohibit that because it sets up such a sweet deal for consumers if they don't feel like they want to pay the mortgage. We might want to prohibit banks from allowing cash out refinances that allow people to strip all their equity, but it's because of the incentives that, that it sets up, and that then leads us to have to bail out banks after the fact. If I'm right then, and if this came about because consumers were rationally responding to incentives, even the interest rate phenomenon, right, the switch over to adjustable rate mortgages was just a response to incentives. It was messed up incentives, misaligned incentives created by the crazy monetary policy of the Federal Reserve, but it was still just misaligned incentives. The put option is just misaligned incentives. And if what's going on is consumers are rationally responding to incentives, I don't see how that is a consumer protection problem. I see very seriously how that is a safety and soundness problem for the banking system, but it doesn't look like a consumer protection problem. Now, that's not to say there wasn't fraud in certain areas, in that sort of thing, certainly. But that's not, I don't believe, what is driving the bulk of the foreclosures, which, as we saw, were concentrated in Florida, Arizona, Las Vegas, and the like. Certainly, there was a lot of fraud in the in the inner cities and that sort of thing. But the problem here, as I see it, is too many brand new houses in the suburbs of Phoenix, not too many loans to poor borrowers in inner city Philadelphia. And I think that it's too many brand new loans to, for brand new houses in Phoenix is what caused the banking failure at that point. And so I think that if we understand that, then we've got a very different sort of way of thinking about it. Secondly, the Consumer Financial Protection Bureau, I think, is premised on a fundamental flaw, which is that we can actually fundamentally eliminate risk. So one of the things that it does, it's got peppered throughout it incentives to try to get people on the fixed rate 30-year mortgages. What we've already seen is that there are risks associated with that as well. And which is to say that you're paying for insurance you don't need. That becomes more expensive for people. And I'll give you another risk that's associated with it. Is yes, it's a great hedge when interest rates go up, but it's a bad deal when interest rates go down. And I'll tell you another reason why England and Europe has lower rates of foreclosure is that when the monetary policy, when the monetary authorities in those countries have reduced interest rates, most people have adjustable rate mortgages, and what happened? Their interest rates automatically fell. In the United States, if you've got a fixed rate mortgage and you're underwater, you can't refinance. You're locked in to a higher fixed rate mortgage. So there is a risk associated with fixed rate mortgages, especially if you're underwater, because it's costly or may even be impossible to be able to refinance. So there is a risk associated with fixed rate mortgages, and we can't the CFPB does not recognize that, I don't think. I think also it does nothing to address the underlying incentives we talked about. So for instance, anti-deficiency laws. Anti-deficiency laws clearly are a major contributor to this problem in Arizona and California. Not only does the Consumer Financial Protection Bureau do nothing about anti-deficiency laws, it actually builds in special protections to make it more difficult for people to make sure that people's anti-deficiency laws are protected. There's an offsetting factor, which is that the way anti-deficiency laws work, you usually only get them for purchase money, not refinance. But still, if anti-deficiency laws are part of the foreclosure crisis, providing additional protection for anti-deficiency laws makes it more likely that we're going to have more foreclosures in the future. It also bans prepayment penalties in subprime mortgages, which prepayment penalties are a vehicle for keeping people from refinancing and engaging in cash-out refinances. So again, by not understanding effect on competition, consumer choice, and that sort of thing. Second, it's got a lot of the terms are just incredibly vague. It allows the CFPB can go after any product or act that is deceptive, unfair, or abusive. Deceptive and unfair may seem vague, but they're basically inheriting the Federal Trade Commission standard, which has become workable. Nobody knows what an abusive product means. It seems to be an entirely new, novel word. Nobody has any idea where it came from. Nobody has any idea what it means. There's no legislative history on it. This is going to be a work in progress. What it does seem to suggest is something that beyond just disclosure, which is it seems to suggest that lenders, at least with respect to some borrowers, may have some requirement that they actually substantively understand certain provisions of their mortgages or their loans. I think this is also a provision that could lead effectively to the abolition of certain complete types of credit, such as payday lending and that sort of thing. The final thing that I think is an error in the CFPB is that it eliminates or severely restricts the ability of the federal government to preempt state consumer protection laws and state laws that interfere with the national banking system. Now, in and of itself, that's not a problem. Necessarily. I still think it might be a problem. But it is a problem once you understand why they proposed getting rid of preemption. And the reason why they proposed getting rid of preemption was that they said that there wasn't enough of a vigorous consumer protection enforcer at the federal level, so they had to allow the states to supplement what the feds were doing. Well, in theory, that's what the CFPB is, right? It's the new federal cop on the beat. And so what they've done is they've basically gotten rid of the original reason for preemption by creating a new federal enforcer, and then basically are now going to allow the states to simply pile on top of that. That is a serious problem historically of states going after financial institutions and that sort of thing, mainly because the financial institutions are out of state and the consumers are in state. And I think that that's going to be another problem that's going to create a lot of regulatory uncertainty. I think all of this together, the uncertainty piled on top of all the mandates and everything else, is certainly going to make credit more expensive and less available. A thing just came in this afternoon before I came in. Community banks and small banks are just testified the other day in Congress that the mandates and the regulations of the Consumer Financial Protection Bureau are going to be so expensive for small banks that many of them are simply not going to be able to afford it, and they'll just be rolled into big banks. In the end, big banks are going to do fine under this. In the end, big banks are the ones who can afford the lawyers and the lobbyists to be able to navigate their way through all the regulations and the costs and everything else of the CFPB. And I think that what we're going to, and they're going to work out fine. So with that, I've got about 15 minutes for questions. So please, yes, sir.
If folks could just come down to the microphones.
Oh.
For the webcast.
Right, this is webcast.
For the webcast.
It's for the webcast. So.
Right here.
I think a concern I have is that your argument is you're using national data for the most part.
Mm-hmm.
You did pick some cities, but
Right.
Cleveland, this northeastern Ohio area, was pretty hard hit
Right.
with predatory lending, abusive lending, Argent, New Century, Long Beach, companies that are pretty much out of business. And the effects of it are much stronger than some of the cities you put up there. And I guess my concern is you're using an argument that a federal agency might be, you're questioning a federal agency that's coming into existence. And in fact, we may need here. For example, you said early in your talk that a lot of the foreclosures were due to unemployment. From 95 to, say, 2002, we had relatively low unemployment in this county, yet our foreclosures nearly tripled. So there's something else at work there. Now later, it is employment. And then I guess the last thing I was going to ask you is, up on the slide, you had a slide for a moment there, a split second, that said Ohio and Michigan. And I was wondering why you, is there anything, I just want to make sure we weren't missing something there, since I'm very interested in what's happening here.
Sure, yes. I just had that because this was sort of the phase 3 thing that I mentioned earlier, and so I didn't want to get bogged down in it, which is that Michigan is one of the other outlier states. That seems to be large, a lot because of macroeconomic problems. Michigan, Ohio, Indiana. And that's why I just skipped over, because I'd sort of alluded to it earlier in terms of sort of the phase 3 and the macroeconomic problems issue. Now, with respect to your specific point about predatory lending and that sort of thing, I guess I've not seen data. I've not seen data on sort of what was driving foreclosures in, say, Cleveland. What the you said foreclosure rates tripled from '95 to 2002.
Yes, approximately.
Right. I'd have to, and I'd also have to know sort of what the, what the incidence of lending was during that period. It's not, I would say it's not implausible to me, and it seems perfectly reasonable to me that that there were cities in which you saw more fraud, for instance, than in other cities. What I'm trying to think about is if it's sort of just old-fashioned fraud on a city level, and I don't mean to dismiss it. That strikes me as a very different problem to think about and to attack than what the Consumer Financial Protection Bureau seems to be set up, which is to say that there's sort of systematic fraud built into the consumer financial, into the consumer financial system. So, and so your critique, I take your critique as being a valid one, which is that what I'm focusing on is primarily on national things. Why I'm focusing on national things is because it's the national banking crisis that caused us to kind of get into this, and that the national banking crisis, I think, was caused more by these particular sets of states rather than say Cleveland, in which I acknowledge that there were certainly in cities and that sort of thing where there were high levels of fraud. So. How high, what percentage, I'd still have to know, and sort of, that sort of thing. So, sorry to not be, that's not a very satisfying answer, I'm sure. But the fact that there was fraud from 95 to 2002 in Cleveland and perhaps some other cities, in and of itself, I'm not persuaded that necessarily makes the case for a new gigantic Consumer Financial Protection Bureau that does what all this is going to do. So.
One of the most important things that you mentioned was the concept of skin in the game, as far as the borrower having some personal risk in taking out the loan. But the concept also applies to the lending institution. Prior to 1995, the lending institution made a loan, and to a large extent they kept those loans, and if the loan went bad, they paid. They lost on the gamble. But since the concept of securitization of the loans has become pervasive, the mortgage broker originates the loan,
yep.
Sells it to New Century. New Century sells it to Morgan Stanley. Morgan Stanley sells it to Deutsche Bank. Deutsche Bank has no concept of what the risk that they're undertaking is. So the regulation that would require that a loan originator maintain some skin in the game would be a disincentive to writing such risky loans, such loans that have such a high likelihood of defaulting.
Right. Yes, thanks. And your first comment prompts something that I should have said, and I'll get to your main point, which is one of the things that's kind of funny about the way I think about this is that nobody agrees with me, even though I'm pretty sure I'm right, which is obviously I disagree with Elizabeth Warren, but if you're sort of noticing, I disagree with a lot of people I typically would agree with, like Peter Wallace and these sorts of guys, right, which is my story has nothing to do with the Community Reinvestment Act, right? It has a little bit to do with Fannie Mae requiring people to make bad loans, right? Again, my story is too many brand new houses in Phoenix, not too many loans to poor people in inner cities, right? So there's this sort of funny way in which when I look at the data, what I see is I basically disagree with everybody, that it wasn't, that I think Fannie Mae did contribute to the problem basically by being the sucker who would buy all these crummy mortgages, but I don't see the evidence that the Fannie Mae was sort of fundamentally pushing a deterioration of underwriting standards, although I could be persuaded if I saw more data about that. As to your point about the banks and the skin in the game, there's a couple interesting observations about that, which is one of the things that's kind of funny about that is to think back on how we ended up with mortgage securitization. Now, how did that happen? Well, the reason was the savings and loan debacle of the late 1980s, right? And what was the lesson we took away from the savings and loan debacle? Banks should not hold their own mortgages. And the reason is because they have to borrow money in the short-term market, and then it's locked up in long-term 30-year mortgages, right? So they said, well, that's what caused the savings and loan crisis, was everybody was keeping all these mortgages on their books. And what we needed to do is be able to get them to diversify their risk and liquefy their risk and that sort of thing. So they created securitization, right? And then they, now securitization is the problem, right? Now, Dodd-Frank takes, I think, maybe ingenious is one way of putting it. Dodd-Frank says, we now know the magic number. It's not a lot like it was under the S&L, and it's nothing like it used to be. It's 5%. The magic number is 5%. Banks must hold 5% of their the mortgages that they originate, and that will get it exactly right. Right? It's like Goldilocks and the Three Bears. Now, maybe it will, but it is just kind of a funny sort of thing that it's a sort of lurching back and forth between these two extremes, and they think they've gotten it exactly right now. But it is obviously a point, right, which is that securitization creates agency cost. And I think it's plausible that that may have contributed to the problem. It could contribute in two ways, which is one could be simply that investment bankers were incompetent, right? Which is that there was just a herd mentality. They had these very sophisticated risk models that ended up being worthless, right? Because the models were only as good as the assumptions they put into it, and the assumptions turned out to be completely wrong, right?
They didn't get any data on the loans that they were
Right, and they extrapolated from a very short data set, right? You know, they basically extrapolated from like 3 years of subprime mortgages when housing prices were rising to think about what would happen when they fell. And what we do see is there is really a clear deterioration in the quality of loans, right? Which is early in the subprime process in particular, what you saw was hedging, which is if you gave a stated income loan, for instance, you'd require a higher down payment. And each of those things individually would make a loan a little bit riskier. After a while, they decided, oh, well, if stated income, makes a little riskier, no down payment makes a little riskier. If we just put it together, it'll just be a little more riskier, right? Well, it turns out that those loans exploded, basically. And basically what happened is if you combine anything with a no down payment loan, basically everything else fell apart, right? And so I think a lot of it was just incompetence. I think the question is suggesting a different question, which is a question about agency cost, which is just the greater fool theory. And that's plausible, and I definitely follow the logic. My only nagging concern about it is that I ask myself, if it's so obvious to me that these incentives were so messed up, why wasn't it obvious to people who were actually spending billions of dollars of their own money at the time, right? Now, one explanation might just be the incompetence and herd mentality. If you've read Michael Lewis's book, that is in abundance on Wall Street, right? Another possibility is that there was a factor that caused that to happen, right? The breakdown of the rating agencies, for instance, essentially suckered people into looking beyond that. Fannie Mae, being a sucker who would buy stuff, might do it. AIG, being a sucker and being willing to write credit default swaps, right? You could tell a story where everybody along the chain understood the agency cost problem, but then in the end, there were some suckers who ate it. I still have a little bit of a and that is plausible. I still have a little bit of nagging concern about that, which is twofold. Which is first, in other countries where you did not have securitization, such as in England, you did see a lot of bad loans also, and you saw a housing bubble in those countries and that sort of thing. I guess I shouldn't say bad loans. But, and it may just be that there was a different risk profile there. Secondly, the other thing that nags me about it a little bit is that the investment banks did the same stupid stuff with their own money that they were trying to get everybody else to do with their money, except for Goldman Sachs, right, who always makes money coming and going, right? But the late Merrill Lynch, the late Bear Stearns, and late Lehman Brothers are late because they basically put their own money into the same thing they were telling everybody else to put their money into. And which makes me question the agency cost story, which is if you're eating the same garbage that you're trying to sell to everybody else, then it may just be something more like incompetence than the string of agency costs. Having said that, I think that there's a plausible story that agency costs did contribute to it, in particular the role of mortgage brokers, which do seem to, mortgage broker loans, at least in some areas, do seem to have had higher rates of foreclosure and that sort of thing. So I think it's a plausible contributor to the problem. So
We have time for one more question.
in a short answer? Yes, sir.
Question. Do you see any correlation between the bad loans and the affiliated business arrangements that are developing under RESPA?
I don't know what the affiliated business arrangements that are developing under
The realtors
risk.
and the banks and so on are paid 49% of the title insurance premium to refer work to their own title company.
That's interesting. I've not. That's not something. I confess that's not something I've looked at. Is that something new, or is that something that developed over this
I've been
period?
seeing it for about 10 years.
Okay.
You're sitting right now looking at a multi-billion-dollar class action suit that's been referred up to the Supreme Court out of California,
Huh.
where the underwriter was paying a lot of money to local agencies. You've got a multi-billion-dollar case out of Bank of America out of Charlotte, North Carolina,
Right.
suing because the title company isn't issuing title insurance. They're just wandering over to the courthouse and doing something strange and wonderful. I was recently referred to as an old fogey because I read the indexes. Now,
Right.
I want to go out on this, on these issues. I've got a whole list of questions for you.
All right.
Are you dealing with any issues on stated income?
Stated income is part of this, but when I look at the data, what it looks like is
I have a client
nothing down. Is
He tried to get a 1% reduction in his mortgage.
Right.
The bank told him to stop making payments so that they could refinance him.
Right.
Then they did the silly thing. They actually figured out what he was making in income. They shouldn't have made the loan in the first place. They pushed him all the way out to a foreclosure, and then I discovered that Mears was in the middle of it, and I so confused the foreclosure, the court dismissed the foreclosure before they could sell the guy's house out from under him. Okay, now,
Sure.
we dealt with the ABA question. They
Time
convinced...
for one more.
Oh, you only want one more? Okay. I think the word abusive involves ABAs. The ABAs are closing things so fast, they're forgetting to pay off loans. And then the title company is sticking the homeowner because of some technicality so that they don't get their mortgages paid off.
Right.
I had one woman call me up and say, the sheriff was just here, and they're going to sell my house, but I'm not in the foreclosure.
Right.
So I checked. The title company she was using, which was an ABA, forgot to pay off the mortgage. So we fixed that problem out. And then the extraordinary thing was she was being foreclosed on herself by the same lender on a second case at the same time. And nobody caught the problem.
Yeah. Let me just say a few words, which is right. Yeah. No. Let me and let me say I think that the foreclosure debacle is just appalling. I mean, it's that the banks did this in such an amateurish way. I just think is extraordinary, and I have no problem with people who've been harmed by that, getting class actions, going for damages, all that sort of thing. I mean, it really is just an astounding and extraordinary sort of breakdown in the foreclosure process. So one thing, and this isn't directly responsive to your point, but it does sort of talk about sort of the complications of thinking through some of these things, and sort of why I keep coming back to the idea of wanting to see empirical data, which is, one of the theories that was out there is that that it was difficult to modify securitized mortgages because nobody knew who owned the paper. What the empirical evidence had suggested, and I think there's it's still coming out, but what the studies suggest was that's not the case. That securitized mortgages modify at exactly the same rate as mortgages that are owned by an institution is what the overall empirical evidence was. And the logic is that it's not that the fundamental barrier to mortgage modification is a moral hazard problem, which is if I call up the bank and say, I can't pay my mortgage, and I'm thinking I'm going to walk away, because I'm underwater. Yes, a lot of people have walked away from their house because it's underwater. Most people underwater have not walked away from their house. If the bank simply modifies everybody who calls up and says, modify my mortgage or I'm walking away, right? Most of the time, those people aren't actually going to walk away. They're attached to their house or whatever, right? So what you have is this sort of jockeying where you've got to try to figure out whether somebody's sincere or not. And so what you end up with is these completely bizarre scenarios, what seems bizarre, which is somebody saying, they'll only modify if I'm 90 days late, right? And it turns out that that's just a proxy for trying to find out whether or not you're really going to follow through on your threat because of this information asymmetry problem and that sort of thing. And so there is, there is a lot of complexities to these issues in terms of thinking about sort of dividing opportunism and bad faith from error in those sorts of things. So I'm out of time.
Yeah, we're going to have to call it there. Please join me in thanking Professor Zywicki for his remarks. There's obviously a lot more to be said on this subject, and hopefully Todd's given us a lot to think about. Before he goes off, we have a little bit of swag for him with the contraband logo that some of you may remember of the. I always think it's a fat guy with carrying a surfboard, but I'm not really sure what it is. But the logo that no longer exists.
My case.
Yes, your case, and there is a reception just on the other side of this wall. So if you go out either door and go around, please join us at a reception. And again, thank you for coming.